Hello everyone, welcome to my presentation. For this week, we'll be talking about time value of money and bond valuation. So without further ado, let's get started. So the time value of money, or TVM, is a fundamental concept in finance that acknowledges the idea that the value of money changes over time. Essentially, a sum of money has a different worth today compared to its value in the future. This principle stems from the fact that money can be invested or earn interest, altering its future value. In the context of bond valuation, TMV is integral because bonds involve the exchange of money over time. The future cash flows generated by a bond, including periodic interest payments and the return of principal of maturity, are subject to the principle of TVM. The value of these future cash flows is assessed in today's terms, considering the time value of money. In the context of bond principle, several factors impact the price of a bond. These include the bond's credit rating, par value, coupon rate, and notably its time to maturity. Investors assess these factors to determine the attractiveness and perceived value of a bond in the market. If you look at the example given below, here bond A and bond B are very comparable, with the only change being in the maturity rate. The maturity rate of bond is 30 years, whereas the maturity rate of bond is 5 years. I'm sorry, it's supposed to be 5 years and not 50 years right here. So, one crucial determinant of a bond's market price is its time to maturity. Time to maturity refers to the period until the bond reaches its maturity date. There is an inverse relationship between time to maturity and market price. Bonds with longer maturities generally trade at higher prices compared to those with shorter maturities. This relationship is reflection of the time value of money principle. Here, both bond A and bond B share similar credit rating, par value, and coupon rates. These characteristics provide a baseline for comparison, ensuring that any differences in the market price can be attributed to factors such as time to maturity. Similarly, bond A distinguishes itself from bond B primarily in terms of time to maturity. With a longer time to maturity, 30 years compared to bond B is 5 years, bond A is expected to pay interest over a more extended period. This extended payment period contributes to a higher present value, resulting in a higher market price. The extended time to maturity for bond A aligns with the time value of money principles. Investor, Investors demand higher compensation for tying up their money for a more extended period due to the inherent risk and opportunities associated with changes in interest rates. This underlies the role of time value of money in shaping the pricing distinction between bond A and bond B. So when interests when interest rate and economic rise, it affects the valuation of existing bonds. This scenario is crucial to understand because it directly influences the market price of bonds, including bond A and B. As interest rates increase, the yield demanded by investors on new bonds also rise, making existing bonds with lower yields less attractive in the market. The impact of an the impact of an interest rate increase on market prices is particularly pronounced when considering the time to maturity of bonds. Longer-term bonds, such as bond A with a 30-year maturity, are more sensitive to changes in interest rate compared to shorter-term bonds like bond B with a 5-year maturity. This sensitivity is a result of the increased exposure to inherent rate risk over a more extended period. Bond A is expected to experience a more substantial decrease in the market price compared to bond B when interest rate increase. This emphasizes the idea that longer-term bonds are more valuable to interest rate fluctuation. Investors demand higher yield for the increased risk associated with holding a bond for an extended period, leading to a more significant decline in the price of bond A. The longer time to maturity for bond A means that its future cash flows are exposed to interest rate changes for a more extended period. When interest rates rise, the price value of the present value of these future cash flows decreases more for bond A compared to bond B. This increased sensitivity is a direct consequence of bond A's extended time horizon. Now, if let us suppose that the interest rate goes up by 10%, here, as you can see, the interest rate has gone up by 10 increase and the present value has changed. Let's comparing the increased rate Comparing the interest rate of 10% to the interest rate of 8%, we can see that bond A would exhibit a higher percentage price change of about 11.8% in response to an increase in interest rate. The prolonged maturity of bond A intensifies its sensitivity, leading to more significant reduction in the present value of in the future cash flows compared to bond B. Since the bond A has decreased more compared to the bond B by about 11.8%, that is 19.6% minus 7.8%. So, using the formula, the present value of bond is approximately $1046.99, whereas the present value of bond B is $1104.3. This numerical example illustrates that bond B will trade a higher price in the market than bond A, and bond A will experience a larger percentage price change if the interest rate goes up. So, as an investor expecting a slowdown in the economy over the next 12 months, a suitable investment strategy would be to invest in shorter-term bonds. Shorter-term bonds are less sensitive to changes in interest rates and are therefore less risky in a slowing economy. Additionally, bond funds provide diversification and professional management which can help mitigate risk in a challenging economic environment. So with this, I'd like to end my presentation. Thank you, everyone. And here are the references. So thank you.